Welcome to the Broken Pie Chart Podcast, episode 289. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, Jay Pestrichelli. All right, Jay, we're back on a down day. I thought we were only going to broadcast on the updates.
We only do all-time highs. I can't believe we're doing one together today.
Yeah, well, all right, let's put this in perspective. Let's just jump right into it. I'm looking at the screen right now. We are in just a shade under a 4% pullback from the recent high. And where does that stack up with some of the other drawdowns? Okay. You might remember the July. So in July, we made the all-time high, down 8.49% into the beginning of August. And earlier in the year, what is this? We had the March high, and into April, we were down 5.46%. So I know the market's down and it feels like that's different. And we really haven't had much volatility as far as the size of 1%, 2%, 3% down days this year. But this happens in a bull market.
Yeah. I mean, 4% off the high doesn't seem terrible. But today felt pretty bad, right? I won't even get it. We'll get into the news in a minute. But when you're right, you look at this, okay, this is pretty normal stuff. Look, and I know you're using closing prices here, but even when we had that really nasty sell-off on August 5th, we still didn't even get down 10% from the high. There's 9.7 or something like that, right? You've got almost 8.5 down because it bounced up. But the point here is, you're right. Don't let this move all by itself be the thing that make you think, oh my gosh. Now, look, you and we follow technical analysis. We just can't help it. It's in our DNA. And, we got a little double top here, right? We couldn't break through that previous high that we had back on July 16th. So, sometimes a double top is called that for a reason, because it stops there and it can't push through and it's at resistance. And I'm not making a call either way on this, but yes, this is a small pullback and it shouldn't really worry you. And by the way, I'm putting that in the Derek's not worrying me category. So you have so much data today. I'm going to keep score. Is Derek worrying me or is Derek not worrying me? This is a not worrying me data point that you're bringing up in isolation. -4 shouldn't, get anybody all worked up. I will tell you that when we look at managing our portfolios, this is why you hedge, right? To have these things in. We actually re-hedged a bunch of portfolios, a week and a half ago, 2 weeks. So it's one of those things that having a regular cadence of managing your hedges and using your rules, which a lot of them would have kicked in for us to roll and re-hedge, help you digest this kind of a move. So that's all I'm saying.
I will say now, we hear from clients, we hear from advisors all the time. By and large, I don't think I've heard from anybody who's panicked today who has hedges on. And the reason why is it probably, if they look, I've been looking at the portfolios as you do every day, and those hedges are going up. The hedges are gaining as the underlying positions are going down in value. And that's sort of what a hedge is, hedge your bets, but it's, so, if you're hedged, I think, we probably still not on the site, but I think 10 years ago, if you're hedged, there's nothing to see here. That's kind of the idea of being hedged, and it lets you stay in the market. So I agree, though. I think this is a technical thing that we're going through now. I have some other thoughts about really it's other things in the markets that are causing, and the equity market is just sort of collateral side damage to that. But yeah, I mean,
before you move on this, because you got an interesting data point here. How often do you get moves like this?
Yeah, I mean,
1.7%, down 4 since the high, right? So how often does this happen?
Somebody posted on Twitter, or X today, I should say. I think this is Barry Ritholtz. So this is a graph, and basically since 2004, the average number of 1% down days in a year is 31. The average number of 2% down days is 10, and the average number of 3% down days is for. Not including today. I'm not sure when they actually, there's not a date on this, but 2024 year to date, 13 1% down days and 3 greater than 2% down days. Now, I think, Jay, you'll point out that one of the days was it was touching 3% down. So you could make an argument that we sort of had a 3% down day in August.
Yeah, I think one of those 3 2s is actually a 3.
But this happens a lot. That's the overall point you were getting to. Like this just doesn't, it's not surprising to have these days.
Yeah, I mean we're in September and we've had only 16 data points show up here, right? We're 3/4 of the way through the year. I guess whatever, 2/3 of the way through the year. So this is still, again, yes, you're right. This happens all the time. This goes in the Derek's not worrying me category.
All right, I'm gonna have to balance this out later.
You got 2 of them. You got 2 not worries. Like, hey, we're only down 4, and look, down days of 1-2%. They don't happen all that often, but it's very regular to see it. This is not an anomaly what we've seen between August and the beginning of September. So got it. I got 2 not scary Dereks. Let's keep going.
Let's maybe scare some people. So one of the things when you think about commodities, and this is my point, maybe it's commodities and currencies that are sort of wagging the dog.
Wagging the dog.
Yeah, there you go. Thank you. Crude oil hit a low for the year today and yesterday. It's the lowest point since December of 2023. Hence, it's a year low. And I think we closed West Texas Intermediate, the front month contract, about 68 and change today, or 69, right around there. So the reason I bring up oil is a lot of times in recessions, commodities actually don't do as well. And the reason is when people are making stuff or hauling stuff around the world, you sort of need oil, you need other materials. And, so maybe is this an indicator that, oh, wait a second, maybe we're on the precipice of a recession because oil is making new lows. So that's one thing. Let's stay there for a second. Any thoughts there, Jay?
Yeah. So we've definitely seen in the past where commodities like oil can be an indicator of slowing manufacturing. I was just going to Google, and maybe you probably know it off the top of your head, what country uses the most oil? Let's see what it says. So when the United States is obviously number 1, but number 2 is China. And so, there have been talks that they may actually have negative GDP, right? So this could be a factor of some lowering global activity versus just what's going on in the U.S. So this is definitely a Derek is scaring us point that, hey, look, if there's less oil, of course, oil has a supply and demand dynamic to it. You've got conflict in the Middle East. You've got OPEC increasing supply. They said they're going to produce more. So I think generally not great as far as an economic outlook. There's not a premium in oil right now, that's for sure. So that typically would indicate lower manufacturing, lower production, which is, akin to the R word of recession.
All right, maybe it's a harbinger. It's a dark cloud on the horizon. On the flip side, CPI, not core CPI, but CPI for when will we see the September CPI? We'll see it in October, probably the middle of the month. Energy, if it's down and making new lows, that's going to be positive for CPI. In other words, CPI is going to be lower. Sort of buoys the case for, it's all good. We can cut rates. We'll get to cutting rates later, but yeah, I think that's a dark cloud. You would like to see. I didn't pull up copper. Copper's the other one you kind of look at.
Yeah.
The other thing I think we need to look at, though, is the volatility in the currency market. Currency markets are really big. The currency market, or FX traders betting on volatility around the U.S. jobs data. So I pulled this yesterday, and it was the one-day dollar hedging cost. They rallied to an 18-month high, meaning if you wanted to hedge a currency, highest cost of hedging it's been in 18 months. And, we had Japan, we had the big carry trade, and that was, like we always say, things matter until they don't matter, and sometimes they don't matter, and then all of a sudden they do. Greece's debt to GDP is higher than it was when Michelle Crusoe Cabrera was broadcasting live in front of the Greek, the ancient buildings in Greek and stuff. Yeah, there you go. So one thing to look at is the carry trade. I think by all reports, it's been unwound for a good degree. But you look at Bloomberg had a chart, beware the 1998 precedent. And it was the idea that the US dollar, Japanese yen took a second deep leg lower despite positioning that turned positive. In other words, traders were short yen, long dollars, and then they flipped and they got net long yen against the dollar, but it still made a new low. I pulled up a chart of the current environment, same thing. We've seen it flip where it was net short yen, so it's the carry, you own dollars, you're shorting yen, and now it's the reverse on a net position. And it's not very, very significant, but it's slightly positive. And I think we made another new low today on the yen against the dollar. And just to remind people, when you have currencies, USD/JPY, it's the second one. The print or the quote is how many of those do you need to get one of the other? So it's always the one on the right. I think when I pulled this, it was about 143.06. So the yen at one point was above 160. When you see that go down, it means you need less yen to buy $1. That means the yen is getting stronger. You kind of got to invert things. We're not going to spend all the time on yen carry trades and stuff. The main point is, Jay, I think the currency's repositioning, this environment of interest rates in flux, you've got commodities lower. It just seems like things are a little tenuous on those asset classes, and I think it's flowing through to equities.
Yeah, so the fear in the currency market is something that also could be kind of a leading indicator here, is what you're saying, because of and it's hard. I think generally a lot of other countries are more familiar with, more in touch with currency pairs, whereas in the U.S. we're like, so what? Because we're the dollar. But the point is, you saw in August what a currency trade could do. When you look back at a lot of, I'm not going to say flash crashes, but flash sell-offs, they have this currency characteristic associated with it, right? So don't blow it off. Pay attention to it. I do see like that double dip that happened back here in, was it 99?
98.
98, yeah. And we'll see if we get that now also here. Okay, that's a scary Derek. Now Derek's got us worried. That's two scaries, two not scaries for you so far.
Yeah, well, we like to balance it. Again, we'd have more listeners. We just really scared people, like some of the clowns on YouTube who just
scary clowns. That's a double whammy.
Yeah, probably. All right, let's talk about I don't know if this is scary or not. Let's see how we react to this. The jobs number came out today. And the way you calculate that for the unemployment rate is you take the unemployed persons, this is in thousands. So what is that? 7.115 million, but we'll say 7,115 and just know you throw 3 zeros at the end of it, into the size of the civilian labor force, which is 168,549. Again, that's 168 million. And by my math, it's a 4.221324 unemployment rate. And I'll remind people again, to be unemployed, when they call you for the survey and they ask you, do you have a job? Yes. Okay, you're employed. No. All right. Have you looked within the last 4 weeks? No. If you say that, you are not in the labor force. You're not unemployed. You're only unemployed if you are out of work and looking for work within the specified time period. So I'll remind people again, Jay, on this, even last month, which, scared a lot of people, more people are employed once again, 168,000 more people. 48,000 people less are unemployed. The size of the labor force increased again, the size of the population. So, look, I don't know. I mean, the employment rate's still low. I still think we're seeing the civilian labor force increase. I'm not sure if this is as dark as people make it up to be, except, Jay, you've talked about the revisions.
Right. So last month was so first off, I agree with you. This really shouldn't have been a scary jobs number today, right? We had growth in the jobs market, the rate dropped. Funny how nobody brought up a big deal about the wage changes. I didn't even see that number flash this morning as everybody was talking.
It was higher. Average hourly earnings are higher.
Wages were up. Yeah. So I look at that's a inflationary piece, but I would say here, the number of employed people went up, but last month, which was so scary, they revised down, and actually even I think they revised down June. So the number of change in employment went down the previous 2 months, went up this month. It still is a trend of increasing, I believe, right? The number of employed, you said, has been up how many months in a row?
44 consecutive months of job gains.
Yeah. Well, that's a good thing, right? So I would say it wasn't a great number, but it was definitely not, I just feel like this was the Goldilocks, but not in a good way, right? Like everybody, if this jobs number was really strong, let's say it was like 250, 300,000, I think the market would have reacted negatively because there's less of a chance of two cuts. I think if this was a disaster, the market would have reacted negatively because there's fear. However, all that being said, this was a middle of the road number, and the market reacted really negatively today, right? Down 1.7, down over 2 on the Nasdaq. The market did not like this. I think it felt there's one little point during the day, I think, where one of the Fed governors said, "Hey, look, like the time of tightened environment is over, right? It's time to make a change." The market didn't really even react to that. So this was, the market is just I think, like you said, Derek, more in a technical move than it is in a fundamental move. This data alone in isolation would not be the cause for a day like we saw today. So there was something else. It wasn't this. I would say this goes in the not scary Derek column.
Yeah. And by the way, like it's hard to look at employment and say, oh, I know a recession's coming. Like it just sort of happens. Like when we're in a recession, these numbers will get bad. And sure, the trend sometimes going into it, and what did the SOM thing? And by the way, she said this time is, it's a little different. I think she even the SOM rule. I think she even discounted her own run.
She did.
Yeah, and the point of that was really an indicator of when they should turn on fiscal stimulus, not necessarily to say we're going into a recession. But I don't know. I mean, I don't think you can game and guess on a recession based upon employment. This is one of the last things to really show up. And typically it shows up, when you see the whites of the eyes of the recession, that's when these numbers really fall apart. I don't know. I do think it's different a little bit because if we look at, this is from Michael McDonough, he has a chart from Bloomberg, native and foreign-born population and employment growth in the U.S. And it's a chart, you can't see it, but the one line shows native-born population 16 plus, and it's the percent growth in that line. And the other one is foreign-born population 16 plus. And until really, the end of 2019, those lines, I mean, foreign-born were higher on a growth basis than native-born. It really went down during 2020 during the lockdowns for obvious reasons. But then it just accelerated in 2021, 22, 23 into 24. No surprise. I mean, the number of people coming to the country is going up. And I think this just speaks to the idea that if the unemployment rate goes up, but it's because there's more workers, that's different than they're laying off a ton of people.
All right. So, I don't necessarily love this chart, but here's the thing that you're saying is, hey, look, we are having the population of foreign-born individuals is up, on this chart, like 22%, and the number of employed is up 26%, right? So the growth is commensurate there. There's more folks here, but they're actually, the employment change is even exceeding the population growth. Whereas native-born population, you're still up though, right? Like the native-born population is up 5.5%, but the employed is up over 6%. So when you think, look, bigger numbers, obviously, I'd love to see. My pushback on this is, well, let me see actually the population numbers, right? If it was, hey, 10 people were foreign-born and now there's 11, and they're all went from 8 to 9 people working. Who cares? Obviously, we know it's much bigger than that. But the point is, the rate is what's interesting, right? The rate of change here. That while you are having a lot of foreign-born individuals here in the U.S. employed, they're growing at a faster rate, and they are, it's not like they're not working; they're going to work, right? So they're being employed at a much faster rate than folks born in the U.S. So I don't know. I felt like I couldn't tell why you put this data point in here. I didn't know if you were being political. I didn't know if you.
No, not at all. It's the size of the labor force.
All right. That's why you put it in here. The size of the labor force is growing.
Yeah. And remember, if let's say, so imagine there's a small town and there's 100 people that live in the town, and of those people, there's 10 of them are unemployed and looking. So they're unemployed. They're actually looking. So 90% of the population is working, 10% unemployment rate. Well, if 10 more people show up, I hope my math will be easy on this. Now the size of the population is 110. And now 24 people are out of work, and let's assume they're working. So 24 into 110, that's a 22% unemployment rate. But did people really lose their jobs? No. What happened was more workers showed up. Do you see what I'm doing there? It's just the math.
Yeah, no, I get it. It's the division, right? And that's when seeing the whole number of growth of jobs is always nice, right? Like that actually clears it up for you. Like in your example, there's not less people working, which is fine. I think there's always been this argument of, I'm not going to make any arguments here. Let's move on from this one.
Yep. Breaking down the U.S. non-farm payrolls. This is the net change month over month. It looks like, manufacturing was down, leisure and hospitality was up, mining and lodging was zero, or logging. So I don't know if they didn't fill out the survey or if they had no net change. Construction looks like added some jobs. I don't know. I mean, we don't have to spend time on this. There's nothing really that really strikes
I'll
me.
tell you the thing that's interesting in this to me, Derek, is that information technology has been negative for the last 1, 2, 3, 4, 5 months, right? Like it can't really tell in June. I think that's close to a zero. But, it was negative this time. It was negative July. It was negative in May. It was negative in April. And while they're not big numbers, like when you think about the things that are pushing the market up, right? It's the Mag 7, it's AI, it's information technology that's doing that. And so when I look at that industry not expanding, it's just a little concerning to me, right? Like I don't, I love that manufacturing. Is it manufacturing or that's leisure and hospitality. Okay, so that's us spending money that could go away quickly. I don't love that manufacturing is negative either. But
yeah, no, it's education and health services. I think is that because people went back to school? Are this seasonally adjusted?
Look at last month, it was big. Look at the month before that, it was up big.
Yeah, okay.
It's a big mover in this number. Like, look at the history here. Education and health services is always a big component, and it has been up for the history of this whole chart that you put here.
Yeah.
So by the way, it shrunk, right? It was up by less than all the other months. So up by 47,000, but that looks less than it has been for the previous 12 months. So I don't know. I would say, I don't think it's a school thing. I think healthcare in general is an expanding.
Well, we know the costs are going up. We know we don't have any CPI stuff in our sheet this week, but
yeah.
The other thing I would say is that when you're looking at the employment, I don't know. I mean, no, I was gonna go a different direction. Let's not.
All
so
right.
the other thing. Well, look, they're still adding jobs. The size of the population is going up. We're at 4.25. All right. So here's, by the way, can I just bring this up, the rounding thing? So we went from 4.3.
Yes.
Yeah. So we went from 4.3% unemployment rate in July to 4.2% in August. And you're like, oh, well, it seems more significant.
Seems like a 0.1 to the good, right?
Yeah. But what they do is they round to, there's only one place after the decimal. So July was actually 4.252831 for those of you keeping score at home. And August was 4.221324. So the difference literally from July to August was 0.03, not percent. That's in, decimal form. Non-decimal.
So it really was flat. You're right.
It was really flat.
Yeah.
And if they didn't round, it would have been 4.25. If they rounded two places, it would be
4.25 and 4.22.
Yeah.
Yeah.
Michael McDonough had this chart, BLS survey response rates. This is something we talked about, I don't know, but probably 6 months ago. And we kind of joke about this, but so the establishment survey, 43.5% participation rate. That means, I guess they get the survey and only 43 out of 100 people, 43 and a half people, you know what I'm saying, responded.
Yeah, that's okay.
The JOLTS is really low, only like 33%. And then the employment cost, about 46%. Going back to 2013, 2014, the establishment survey was, I'm guessing, about 63%. So you and I were sort of joking off air. Is it like, are they not responding? Are they not filling out the survey? Because like, I'm so busy hiring, I don't have time to fill this out. Or they're like, I got nothing to do. My business stinks. Oh, cool. I'll fill out this survey. Like, I don't know what to do with this. But
I think you're questioning the reliability of the survey, right? And so much like the market movement like today happens based on a survey, and you're saying, the reliability is low because the sample size is getting lower. The reliability is lower because the sample size is getting lower.
Sure.
All right. So listen, I'm trying to score this one for you. I put the workers are growing in the don't be worried category, but I put the survey response rates are unreliable in the worried category. So to, ignore everything else we just talked about.
Yeah. Well, it's just one of those things. Like, are the people filling out the surveys the one where the businesses aren't doing well? And we're missing the ones who are, I'm like, I don't know.
Well, I've never gotten one of these surveys. I've had a business for 13 years, 14 years.
Never gotten a call, huh?
No, they don't call me.
I don't know. They might have called me. I probably just hung up on them. I don't know. All right. The other thing is, another way to look at this is Russell 3000 companies. Bloomberg put this out, job cut mentions and earnings calls. And what you see is the most recent high was what, December to March of, December 22 to March of 23. Since then, the mentions of job cuts on earnings calls has been going down. So companies are talking about this less, and it's trending down. So I would put this in the good category.
Yeah, this is look, companies are not talking about cutting workers as much as they used to. That's in the good category. That's in the not scaring us not category, the non-scaring.
Didn't Intel just announce, it probably isn't in this data, but Intel just announced job cuts, right?
Listen, Intel's got all kinds of challenges.
They're down, aren't they down like 70% from their high? Could be. I mean, that used to be the one stock. That used to be the stock in the early 2000s.
Yeah, right. You wouldn't be like AMD. I want an Intel processor, right? I mean, remember they put commercials out talking about their processors, like "ooh, inside,
That's right.
Intel inside," right? Had that little jingle, but no, not so great these days. Intel.
How much government money did they get? Seems
They
like
didn't.
that.
It's funny you say that. So I heard an interview recently. They didn't get it yet, and this is money for everybody to build foundries, right? To build new chip producing facilities in the United States. So they don't get the money until they show that they kind of achieve certain benchmarks and milestones. But it's billions that are earmarked to go to Intel. They just haven't received a penny of it yet because they actually haven't reached the first milestone.
I saw something on Bloomberg that they're weighing. This was on Bloomberg TV. I think it was the one of the Australian reporters, and she had a piece that said they're weighing options, including a foundry split, to stem losses. So they would split their business, I guess.
Huh. Okay.
Or and
What else
I guess
do they do?
Well, I mean, don't they make GPUs? So they make GPUs. They make.
That's not chip stuff.
I don't know what they're going to do.
Yeah.
It's down 70%. Like that. All right. So we didn't plan on talking about this, but like totally not, don't trade off this because literally you can tell
we've done no research, full disclosure.
Yeah, but like, do you buy Intel 70% down here? Like,
ugh, that's an ugly chart. Ouch.
I'm looking at their financials right now. It's an ugly chart.
All right.
Very ugly chart. Let's see.
That doesn't mean short it either. It's just not you. If you're a bull, it's an ugly chart. If you're a bear, you're dancing.
It is funny though that sometimes people will look for things that are really beaten down, and that works.
No, sure.
If it's mispriced, sometimes it works.
It's a whole theory. Dogs of the Dow is based on this.
So last 12 months, their operating margin is 1.35%. Their net profit margin is 3.96%. What is Nvidia? Isn't Nvidia like 54% net profit margin?
75, I thought.
I will tell you. But I'm looking at their financial numbers aren't great last couple quarters there. All right, now I'm curious. I gotta look. I just talked about Nvidia last week.
While you're looking that up, I looked at the options on Intel. There's really no skew here to the upside, right? There's just calls are a little more expensive, but that's a cost to carry trade. I just looked out to March, 6 months. So you're not, it's there's 19s. Let me look at the 19s here. Yeah, 3%. No, there's not a lot of upside juice on this thing. If you're wondering kind of the probabilities of this going to, I don't know, $30, well, that's a pretty high rate. Let's just say a 25% move to 24, the delta on that is 35. So we just round to say 35% chance this gets up to 24, Yeah, I think if you told me how are you going to get long on this thing, I absolutely would, I would use options and use a hedge and collar it up, right?
Either buy it, sell a call above, buy a put, maybe a call spread above, or
I mean, you can, if you bought the shares, right, you can sell. I'm using March. You could sell the 27% out of the money 24s. So you sell the 24, get like $1.50 for that. And you could buy the 16 strike, which is a minus 15% for $1.50. So you could put on a downside risk of 15 and an upside capture of 27%. And that option combo will cost you, that's break even. That's a zero cost collar. So that does skew to the upside a little bit there, Derek. Meaning the bottom the way to interpret that one is the bottom might be in because buying a March 16 put looks less expensive than maybe it has in the past. But not making that recommendation, you still could lose 15%, right down to 16.
So I'm looking at a long-term chart, and if you bought it at the highs. The all-time high is $66.84, June 30th of 2000. The closest it got to that was March 31st of 21, got up to 64. So almost all the way high, but now it's down to 1889.
I'm going to take a look at January 2020. I think I see $69 there. Do you see that?
Oh, you know what? It's a quarterly chart. So yeah, let me change my chart to
like you said, when you don't like the chart, just change the time frame.
That's right. I'll change it to monthly. Yeah, there you go. So yeah, okay.
So let's round to 70 down to 18. Not been a great
what? I'm using closing prices too. That's the thing. Intraday probably did get up there.
Yeah, I'm using daily. Yeah, down 75%.
All right. Well, I mean, if you want to buy it. If you want to short it. Good luck. And if you don't want to buy it, don't buy it. So I don't know what to tell you on this one.
Am I buying this or Nvidia? Which one are you buying, Derek?
Well, if you buy one of the indexes, then inevitably you're buying less of this and buying more of that. But you're buying them both, yeah. Probably a better way to do it. Okay, let's talk about the Fed cuts. Well, or imminent Fed cuts.
Right. Let's talk about it.
So the implied probability it's 100% implied probability for the September 18th meeting coming up of 25 basis point cut, a 32% probability of 50 basis points. The November meeting has an 86% probability of 3 cuts. So it's pricing in another and then another. So they're basically saying right now, by November, you're almost at 75 basis points. But it looks like 25, then 25, and then by December, maybe 50 in December. These kind of change the probabilities. So I don't know.
1, 2, 3, 4, 5 cuts is the highest probability for December.
I see 4.59 cuts.
Yeah, I don't love it. I don't love that math. That just seems extreme for the market to be betting that way. And look, you and I have been saying we don't know. We at least we get to be right up until September 18th, where we've said I don't know why the Fed has to cut it all. Although we have leaned towards, hey, if they're going to do one, it was probably September. I think we've been saying that for 6 months now. And so that just dumb luck that seems to be lining up. But 4 cuts after that? Come on. Really? Meh. It seems extreme. I mean, Derek, like you gave us 5 things to not be worried about, but 3 to be worried about. Like the Derek metrics here tell me why. I don't know why I'm so worried about all this. Like that is not happening because the Fed just CPI, we beat inflation, time to lower rates. That only happens if things are nasty.
Yeah, we keep saying that it's like you don't want rate cuts.
You don't want these. You don't. I agree.
Why do you want?
You don't want them. Not right here.
No, that's right.
But let's talk about the last couple of times where you saw that first rate cut. Like you've got a nice set of data.
Well, I'll give you a dark cloud. The dark cloud is possibility is, how young kids sometimes they're like, hey, can I go out can we stop for ice cream? And you've told them no. And then they sort of talk themselves into it and they talk themselves into it. And then they ask you again, and they're like, no, we already said we're not stopping for ice cream. And they get very upset. If the market doesn't get these cuts, I think it will be very disappointed. Like it's talked itself into, we're getting all these cuts. And if it doesn't happen, it could be a problem.
You are 100% right. The market will be disappointed if we don't get, at this point, like what, 4
cuts by December, right?
Like, well, I mean, 4 or 5, like this, we're not getting ice cream. I love the analogy.
That's what it is, right?
Don't be a brat, market. You're not getting ice cream. You're not being a brat.
And if we need 4 cuts, that's not great. Like the market is almost saying, oh yeah, we're going to get 4 or 5 cuts by December and everything's going to be awesome.
It can't be both.
Cuts, no, you can't. It can't be both.
Be both.
No, it cannot be both. All right.
I'm putting that in the worrisome column.
I think it is.
It can't be both.
No, because part of this rally, besides, I mean, the expectations for interest rates were not this many cuts. And now that the market thinks it's getting this many cuts, the market rallied on that in advance of that. It's not rallying as, look, we're only, 4% from our most recent high? It's like we're still up, 15% for the year, something like that? But I don't know. All right, let's go to the size of the first cut. This is from Bloomberg, titled "The First Cut Isn't Always the Deepest." That was a Sheryl Crow song, right?
I don't know, but maybe. I think you're right. It feels like that's not the exact words of the title, but okay.
Is it?
I think the first cut is the deepest. Now I got to Google that. Sorry, Sheryl Crow.
Sheryl Crow. All right, you looking it up right now?
Yeah.
I'll sort of vamp for a time
it's the
here.
first cut is the deepest.
Okay. All right.
The deepest.
Well, all right. We'll leave it to Sheryl Crow then to tell us what's going on.
She says the first cut's the deepest. What do you think?
Well, Bloomberg says the first cut isn't always the deepest.
Okay.
All right. So their point here is that jumbo reductions usually came amid job losses and high unemployment. What they did was they didn't show all the cuts, but they kind of went back to, April 1st of 1980 was an 850 basis point cut. That was their initial cut. And
that's wild.
Yeah, it's pretty wild to look back. But let's look at the most recent ones. So 7/31 of 19, 25 basis points was the first cut. The non-farm payroll right before that was plus 90, so I added 90,000 jobs. And the jobless rate was 3.7%. There were no job loss prints. In other words, we didn't have a month showing job losses. We don't have those now. And our unemployment rate is 4.2% rounded.
Yep.
So then when did we do a first cut at 50 basis points? It looks like September 18th of 07, 50 bips, had two job loss prints. So 2 months where we had prints. Non-farm payroll is minus 25,000 before, 4.6%. And then January 3rd of 01, 50 basis point cut. We're already in a recession at that point. And 3.9% unemployment rate. Like, I think you had mentioned this, Jay. Like, what stood out to me here was how low the jobless rates were when they were cutting.
Yeah, I mean, you're right. When I look at this, I was like, like 4.2% is the jobless rate. Doesn't seem high enough to react to, but maybe I'm like, the Great Recession is scorched into my brain when we saw those kind of wacky numbers, and obviously, the pandemic. But I would say that it is. I mean, Derek, take a look at this, right? So, you're right. You have a higher jobless rate than the last time. That was 3.7. We're at 4.2. Okay, so that seems a little worse. But there were no job loss prints leading up to that cut. So, and the non-farm payroll was 90 instead of 165. I'm looking back at a chart of like what was going on in the market in July of 2019, right? And the market had kind of sold off a little in June. And then you had this little wiggle that went on in, August of 2019. But, the market was fine. Everything was fine. Obviously, 2020 is a different story. But the market seemed okay. It had pulled back a little bit. I'm trying to, you can get this cut in an environment like we're in today. And so I actually think this is encouraging where you see a job cut in a couple of these scenarios. The market continued to go up because it really wasn't all that scary. So, I was, it feels like we don't have to me, but, when you look at this, we're not out of whack if it happens now. It's not like this is unprecedented. The economy's fine. Why are you cutting? It's happened here. And the markets continued to appreciate afterwards.
The other thing you see here is, like June 5th of 89, let's see. Yeah, I mean, that was sort of 6 months before a recession, or maybe a little more than that. The 95 one, I keep going back to 94, 95. 95, the unemployment was 5.6. We had one job loss print, although plus 236 in the non-farm payrolls right before it. So the negative print must have been before that. That was a quarter point. Yeah, I think this is in the sunny category.
Yeah,
and
this isn't a not worried category. You can have you can have a cut, and things could still be okay.
Yeah.
Be fine going forward. It doesn't have to be scary. I'd like to see what happens when you do. But how like 850 basis points? It's crazy in 1980 to cut like that. But that tells you how high rates were.
Well, it was 1920. Probably the Fed funds rate was like 19%.
Yeah, I thought 17, but yeah, you got it. That's right where I was thinking.
I mean, something like that.
Different world. Different world.
All right.
Very nice to see also the Fed funds rate on this little chart. That
no, it would actually. It would. So I guess, the other thing I'll say is it's sunny because maybe this is just a return to normal, and they're sort of normalizing rates.
Yeah, you could get cuts and it's not so scary out there.
Because that was the 95. There was no recession in 95. There was no problem. Markets kept going up afterwards. So, and I do like the 94, 95 corollary. We'll see. All right.
Okay.
Earnings. This is in a sunny category. Forward earnings estimates. Now, these can change. These are analyst expectations. Of the next 4 quarters, analysts are forecasting 10.49% growth in earnings per share, 12.95% in a year plus one. So not the next 4 quarters. It's quarter 5, 6, 7, 8 from now. And, year plus 2, about 6.7%. In the drawdown, our forward PE ratio is now 20.95. So, and then the other thing we looked at is the change in earnings estimates. And I think for full year 2024, full year 2025, they are lower than they've been recently. But if you didn't look closely, you'd say these are pretty flat since the beginning of June. These are the earnings estimates. So I think this is actually in the sunny part. Now, these could be wrong. Maybe they're totally out of whack. But corporations are still growing their earnings.
Yeah. So look, I'm gonna tell you there's a sunny piece, which you just said, right?
Mm-hmm.
That earnings are still growing at 10%. But I will tell you, the market word is today that PE on the forward 12 still is what? 20?
Almost 21. Yeah.
Yeah. So still considered higher than average. And the fact that you just said earnings really haven't grown this year or recently, right?
No, they've grown.
Grown.
The expectations haven't gone up, but
Sorry,
the last report
haven't grown. Got it.
We've had nice growth.
Yeah. So yeah, I misunderstood what you said there. So I say the PE is a little scary, but certainly the fact that there's still projection for earnings growth makes sense, and that has been stable. So I'm going to give you a 1 and 1 on that one.
Well, your point's well taken, and I'm just not enamored with it. That's not the right word. But when you think about where a market is and then where it goes to, how do you explain the growth or not growth? And you either have multiple expansion, you have earnings expansion, revenues. Really, it's revenues. And then you look at margin expansion. The dividends could grow. Companies could buy back shares. So to your point, when we're already elevated, you got to kind of say, okay, well, does it go from 21 to 23 on a forward basis? Does it go from 21 to 24? There's less room to grow on a multiple standpoint. And so I think your point's well taken there. We are a little bit high on the forward basis.
A little rich.
So you need revenues to grow and you need margins to stay constant or grow, and which flows to earnings. So, okay. Let's go to volatility, Jay. So VIX index is, when I took this, it's about 2236. So, higher than, we're in a higher VIX regime right now. Looking across the curve, though, 1 month, 2 month, 3 month, 4 month, and so on and so forth. Spot VIX, the one you see on CNBC, is higher than the other, the back months. But it's pretty flat. I mean, everything's kind of hovering right around that 20. I would say December and January are below 20, but then, October's still the one almost 21. Like that's the highest point in the VIX curve. So I don't know. I mean, we're at a higher VIX, but it's not a crazy spiking VIX for sure this time.
Well, we'll see. This will come. People will hear this after Monday. We'll see what Monday looks like after a bad Friday. That's always an interesting combo. Well,
they'll hear it on Sunday, actually.
Oh, they'll hear it on Sunday. Maybe. Okay, got it. Well, we'll see how Monday looks.
Yeah.
The VIX is definitely, look, higher volatility is expected. But with Derek, a VIX of 22 tells us we should expect what move per day? Like a 1.4% move? That's kind of the expectation, right?
1.39%.
That was a good guess.
Yeah.
So look, a day like today that moved 1.7, that didn't feel great. It's kind of what the VIX is telling you should expect, right? Over the next 30 days. Like this is, so I don't know if today felt bad to you, which it did to me, then maybe, you should expect a little more here. All the data you and I look at when it comes to the VIX, and we do a lot of VIX, we have one strategy that's tactical based on some pieces associated with the VIX. That strategy is not telling us all clear, right? It's telling volatility's here for a little bit. Hasn't told us we've seen capitulation. I put a preliminary numbers in, doesn't tell us today is capitulation either. So look, who knows, right? We're not saying the market's going to go up, but just from a volatility perspective, there's nothing in the data that tells me we are going to see a smoothing and calm market over the next 30 days. So look, this is no surprise, right? September and October are historically volatile months. So to see the VIX sitting here at 22, where did we actually close on the spot today? 22.38. Yeah, like that is, that tells you that you're going to have days like today in the mix. Some a little more, some a little less. So I would say the VIX is telling you not smooth sailing. I would say this is a little in the scary category, but not, hair on fire category. I'm putting it in the dark category.
I will also say that this is why some of the core things we do, we're hedged all the time, because the VIX has risen, but most of our clients or advisors' clients, they already have hedges on when it was cheaper. Like nobody wants protection when it's really cheap, but a lot of people should have
the best time to buy it.
It is the best time to buy it.
Which, there's some folks that would say, the VIX is a contrarian indicator, meaning, when there's panic, that's the time you should be buying, right? Time to get bullish. But, you're early or you're late on that. Who knows? You need to have a little, you need to have a time frame that's flexible on that. But look, just a week ago, VIX was trading at 14. So it's up 50% since there, and that in relative terms doesn't mean all that much. To go from 14 to 22 is, that's a decent move up. Derek, besides the nonsense that we saw in August, the beginning of August with that big spike up, like this is the highest the VIX has been in the last 12 months, maybe even longer. So, the VIX is telling you not all clear, but hello, everybody has expected this volatility since the beginning of the year with the coming of the election, right? This is very, very normal cycle stuff. So normally I would say put it in the not worried, but I think people don't like 1.5% moves every day up or down. So I'm going to put it in the worried. You're just getting into the beginning of this next 2 months of choppy waters. So expect movement. That is what the VIX is indicating here.
I mean, we've said that, and we noticed in our own sort of experience, September typically is not one of the best months for the market. But still, I mean, you probably have a 50-50 chance that it will be up versus down. But on average,
a little less than that. Historically speaking, it's a little less. And I know you're being
on average.
You're dancing around a little bit. It's the only month that since 1950 has averaged a negative return. All other 11 months have
Yes.
positive returns on average. September is, on average, the worst month of the year.
But what are you going to do? Sell? And especially
No,
if you're
we
hedged, like
hedged.
why would you sell? There's
We
nothing to
hedged
do.
going into it. Yeah, that was it. We think, look, you don't. It's not timing the market. We know this. It's the time you stay in the market. You want to avoid some of that volatility. You hedge it. You roll it. You lock in gains. There were gains up until that point. If you hadn't done activity like that, like this is almost the most predicted sell-off you could have had, right? The most predicted volatility you could have had, right? And I don't think it's over either. Like the volatility, right, being over. Like this is if you didn't take any activity there, then you get what you get, right? Like you were comfortable with risk going into September if you didn't take advantage of that second chance at an all-time high after the August bounce. That was a little accusatory. I'm not victim shaming here at all. Sorry.
All right. Well,
today you like look in the mirror on this one. It's on you.
the problem with trying to time the market is you have to be right twice. You have to decide when to sell and when to get back in. And the problem with that also is that you get influenced by all the stuff in the media at your current sort of state of mind. And I go back to 94, my first full year in the markets. There were people in cash because of 87, which wound up being an up year. We know that. It's very, very bad. That was October. But it's just hard. That's why we're like, there's really nothing to do here. All right, here's a public service announcement. And this is about trading VIX options. VIX options are based upon the VIX future, not the spot VIX, which you see on TV. That is not tradable. So I took a look, and coming into the year, everyone's like, I think there's going to be a lot of volatility around the election. And I heard some people say, well, I'm going to buy options on the VIX. Okay. You and I would naturally say, are you buying the VIX future? Or are you buying the option? Okay. I'm buying the option. Okay. Which option are you going to buy? Well, I'll buy an option in October. Why October? Because I know it's the highest volatility on the VIX curve. In January, the end of January, you could have bought a VIX $20 call option, which pretty much was at the money because that VIX future, even though the VIX was much lower, the spot one, that VIX future was still trading right around 20. $4.20. That option today, it looks like it's $3.15 for October. So even though things have gotten more volatile, you are down money. Now, the question comes up, could you have, what about in August when things really spiked? Remember, the spot VIX doesn't trade, spiked. The VIX futures did trade, and they spiked as well. All right, so that $4.20 option at the very, very high, and if you sold, if you knew that you could get out at the very, very high, you could get $8.96. And then it quickly went back down. I bring this up because it's sort of the public service announcement. Trading VIX options are very hard because you got to know what to buy, when to buy, and you're making a sort of determination on where something is going to be in the future relative to where it is now. So if you're buying an October VIX option and the VIX future is 20 and the options, you get what I'm saying. It's like pretty much you're treading water, except for that one little period, and who knows whether you would have actually sold.
Right, so yes, look, and right, you have to get timing and direction right. You got to get when it's going to move and how far it's going to move. But Derek, what if I bought one of those VIX ETFs? Like, why couldn't I just do that to be invested in potential volatility? What do you say to that question?
Well, those are buying, usually the next month and maybe bleeding over to the following month. So the near month and the second month, you have carry cost. So if you don't get any volatility and VIX comes down, you're losing money. You're sort of, you've got natural decay in the VIX futures rolling up and forward. So I think that's where you were going, Jay.
Yeah, it's like they have the same problem is my
Yep.
point, right?
Yeah, yeah, yeah.
And if you do like a UVIXy, which not only has this problem, it also has, the compounding impact of declining the price. Like if you're going to buy these thinking like, all right, let me just get long, or let me use an ETF to play out my thesis. You still also need to get your price and time moving properly. The ETF, not a recommendation, but an ETF that we trade from time to time is the SVIXy, which is the short VIX future. So essentially, this is an ETF that takes advantage of that natural contango, or we'll call it decay in VIX options. But if you're bearish the market and bullish VIX, you short this. So I just gave you a triple negative. But even this ETF, right, that is based off of the VIX futures, still hard to get this one right, because if you think, hey, at some point the VIX is going to spike, right, and I want to be bearish on this short VIX fund. If you did that at the beginning of the year, exact same scenario, right? This ETF was trading in January at $51. After today, with the move up and the sell off in the market and the move up, it's at 47. So it's worse. So you got a little benefit being short the SVIXy. That's about it in all of this time. So look, if there is a vehicle that you want to take a position on, by the way, there are options on SVIXy, right? So if you don't want to short it, you can buy puts on SVIXy. So now I've got, 4 derivatives, right? So you got the S&P has options that define the VIX. So first derivative. Then you've got the futures. Then you've got this ETF, and then you do options on that ETF. Yes. Fourth derivative, if you want to play this one. Like all of those things make it very, very difficult and complicated when it comes to trading any kind of VIX product. So look, I know people think like, I'll just buy the UVIXy, which is the leverage VIX, and when I get the pop, I'm golden. Yeah, but you got to get it exactly right, because every day it doesn't happen for you. It's moving against you. So,
well, UVIXy is a good one. You mentioned that one. That's the up VIX.
It's a double up VIX.
Yeah. So let's say you bought that. Here, I'm looking at the price. The very end of December, $42.20. At one point during the year, into middle of July, you were down over 50% in that. It went down to just under $21.
Yep.
Yeah. Let's say you held at some point, and sold at the very, very, very top, $61 and change. Remember, you bought it at 42. That's if you sold.
That was a lot of pain to experience the third largest VIX spike. And you didn't get paid a lot for that one.
Yeah. And people use it because, I prefer to directly hedge the assets that I want to protect, not have sort of black swan protection in there.
Fourth derivative? You don't want a fourth derivative to protect?
No, I'm just saying, like if we're like the way we run some of our hedge portfolios, where we'll buy put spreads, or we'll do some synthetics on it and own puts at different areas, or sell volatility other places. So the point is, like if that's the way we hedge the underlying asset, I don't need to go out and do black swan stuff and own some of this that has the carry problem. And like you said, if you don't get it right, maybe it protects you, maybe it doesn't. But anyway,
there you go.
Public service. That's neither sunny or cloudy.
You want me to go through your scorecard for today, and we'll see how Derek feels?
Yes.
All right. So I had 6 scaries, 6 dark, 6 worried. It was commodity, currencies, some surveys response rates are unreliable, 5 cuts. If you don't get it, you don't get your ice cream. PE ratio is still elevated, and then the VIX is going to be volatile for a little while. On your sunny side, on the not worried, Derek, hey, we're only down 4%. Minus 2% happen all the time. Unemployment, folks are growing. Like we get more people are working. Job cuts are lower mentioned. Oh yeah, earnings calls, job cuts are lower. And the first cut is shows that, hey, maybe it's not so bad. You can cut, and earnings growth is 10%. So you came in at 7 goods, 7 not worrieds, 6 worrieds. Good job keeping it really even this week, Derek.
Yeah. Our audience will hate us.
You
We got
didn't
to be
talk about
really
Bitcoin,
negative
though.
or really positive. You know,
You didn't bring up Bitcoin today in the discussion.
why would I bring up Bitcoin? Is it down today? I don't watch
down.
Bitcoin.
Yes. It's down. I don't know, 4.6%.
I don't even know how to do
I just
the.
like to give a little bash, so much for that non-correlated diversified asset. It's got more beta than the market. Okay, you didn't want to bring it up.
Well, I think Bitcoin is an abject failure at hedging inflation. It's a risk-on asset.
It's absolutely a risk-on asset. I agree. Actually, I'm looking. The Bitcoin futures are right now down 5.7%. Nasty. I've said the word nasty a lot today.
It's been
a trigger we've nicknamed the nasty, haven't we?
Yes.
So
So
that is not fired yet.
it was 73,000. I didn't even know how to pull. This is I had to look up what the cross to the dollar was on Bloomberg. I didn't know how to pull that up, so I just pulled it up, and it looks like from the high is this September, we're down 27.75% in Bitcoin. Is that right?
Great. Something like that. Yeah, I didn't track the actual number. I believe you. Not great.
Doesn't this? I mean, it kind of looked like the tulip bubble, and then maybe another tulip bubble.
No,
No,
not tulip bubble.
Kind of. Well, all right.
Listen, but it went from where did it go during the pandemic? Right, like 10,000, 15,000 from 70,000. That was not a fun ride.
I didn't even know the price until I looked at this chart. That's how little I care about Bitcoin.
There you go. All right, but your listeners do. Talk more about that.
We should talk about Bitcoin.
All right, another day.
Another day. Jay, any recommendations?
I'm going to see Beetlejuice tomorrow. So very excited. I'm a huge Beetlejuice fan. You know, Halloween's my second favorite holiday, and I usually go all out, do a haunted house in my garage for the neighborhood. Like, love this one. One year we had a Beetlejuice themed haunted house. So yes, I'm very excited about Beetlejuice. That's what I got.
What was the other Halloween movie that was really popular from in the 90s? Not like a scary one. It was just more of the I can't think of the director.
You're not thinking the no, you're not thinking that other Tim Burton where
Tim Burton. Exactly.
Santa Claus gets kidnapped by the Halloween guy. Yeah, it's kind of more of a not a claymation, but like an animated type. Movie. Yeah. No, that's not it. It's not Beetlejuice.
Is that Michael Keaton in Beetlejuice?
Are you seriously asking me that question?
Is he back?
Like, are you asking that? Of course he's back. Nobody else could play Beetlejuice.
Okay.
Yes.
He's kind of had a resurgence with, it's funny, like he was out of favor for a while.
He took a break.
Yeah.
He took a break. And when he did, what was it, Birdman? When he came back, that was it. No looking back for Michael Keaton. He's been in a lot of great movies. And by the way, Birdman was awesome. But I think that was the name of it, right?
And then he also did the series on Hulu about the Sacklers.
Yep. Hey, look, he's in the Marvel movies. He's a bad guy in some of the Spider-Mans. Like, look, Michael Keaton's back. Yeah,
I wouldn't know that.
He did a Batman spot, by the way, right? In the Flash movie, he was Batman again.
Oh, okay, all right.
Look, if you're not tracking Michael Keaton, I don't tell you. However, my favorite role besides Beetlejuice is when Mr. Mom was great. That was a great one. But Multiplicity, hilarious, where he's multiple of himself. He even dupes himself. It's a very funny movie. If you haven't watched that one in a while.
I thought you were going to, what was the other one? Gung Ho? Wasn't he in that in the 80s?
Yes. He's a lot of movies in the 80s.
Still around.
He's doing great. Huge. I'm bullish Michael Keaton.
Isn't he, I don't know why I remember this. That's not his real name, right?
No, he just came out and said his real name is Michael Douglas, but whatever, is it SAG? What's the Actors Guild? SAG wouldn't let him use the same name. So he's thinking of going with Michael Douglas Keaton as his new name. But he's Michael Douglas as his real name.
Not to be confused with Gordon Gekko.
See, now, if you asked by you asking who's playing Beetlejuice, it was almost like saying who played Gordon Gekko to me. on Wall Street.
I just mean, is he going to be in the new one?
Yes. When you clarified, then I was like, okay. Now
of course I remember him in there.
Very upset.
So I watched Bad Monkey, and I wish Apple TV Plus would just drop all the episodes.
Just do them all at once, Apple.
I know.
I'm not canceling. I know. I'm with you. Like, put them all out. Like, right? That's what you're saying. Like, I'm not going to cancel my subscription because, oh, let me go one more week because I'm waiting for you to release it. Just put it all out.
Just give it to us. And, I had batched it. I think I watched 4 in a row. And then the 5th one came out this week. Maybe it's 3 and then 4. But I think it was 4. And it was great. And I got to the end of it. I'm like, really? It's going to be 1 a week for a while. So, but I think Vince Vaughn is really good at it. I like it. So far.
I'm bullish Bad Monkey.
Bullish Bad Monkey. All right, Jay. I think we covered it.
That's enough.
And next week we'll talk about Bitcoin. Or we won't.
Bye, Derek.
All right, everyone. Thanks for listening. Remember to give us 17 stars. If you're not rating us 5 stars, don't bother. Derek.moore at Derek.moore at ZegaInvestments.com. That's the better one to reach me at. Yeah. All right, Jay. Thanks. See ya.
Bye, Derek.
Bye.